One of our recent clients is a married couple with a net worth of $13 million. They own rental properties in 3 different states and live in California, one of the most litigious states in the country. They already carry strong insurance coverage, including a $5 million umbrella policy. By most standards, that's a very solid protection plan. But they were still concerned about one thing. What if something goes wrong? A tenant gets injured on one of their properties, a serious car accident, a guest sleeps at their home. Could one of those situations turn into a lawsuit that reaches beyond their insurance and into their wealth? And honestly, at $13 million in assets, that concern is completely reasonable. At our recommendation, they were open to increasing their umbrella coverage to at least $10 million. But their current insurance company said no. $5 million is the maximum they offer. We did look at the possibility of moving the coverage to another carrier, but one of their properties sits in a fire zone. That would have made underwriting significantly more restrictive and could have pushed their premiums 3 to 5 times higher than what they are paying today. At that point, the question shifted from simply buying more insurance to something more important. How else can we strengthen the protection around their assets? In this video, I'll walk you through several strategies you can use to protect your assets from lawsuits and creditors. Some are incredibly simple to implement, and one of them costs absolutely nothing to do. Let's start with the core problem, because most people don't fully see it until you lay it out in front of them. Your wealth is like a castle, and your insurance policies are the walls around it. The problem is, most people build those walls early on, when the castle is much smaller, and they never update them as the castle grows. Here's what it looks like in practice. You accumulate $5 million, $10 million, $13 million in assets over the years. But your liability coverage was set up a long time ago and never revisited. So you might have $300,000 in liability coverage on a rental property that's now worth $1.2 million, or a $500,000 auto liability limit when your total net worth is $8 million. That gap between what you are covered for and what you actually own, that's what a plaintiff's attorney is looking at. Because when someone sues you, they are not just suing the property, they are suing you personally. And if the underlying policy isn't enough to cover the claim, that lawsuit reaches straight into your personal assets. Most people are sitting in that gap without realizing it. And the fix is usually not as complicated or expensive as they expect. Before anything else, you need a solid foundation. And that foundation is your underlying insurance coverage. Think of it like a plumbing in a house. Nobody sees it, nobody thinks about it. But if it fails, everything else fails with it. Your umbrella policy, your LLC structures, all of it depends on the foundation underneath being solid. What does that look like in practice? For rental properties, a landlord policy with robust liability limits, not just the state minimum. For your home, a strong homeowner's policy. For your cars, high auto liability limits. A reasonable starting point for auto liability is $500,000 per occurrence. Some carriers will go up to $1 million, and if that's available to you, it's worth having. Here's why this matters more than most people realize. Your umbrella policy sits on top of your underlying policies. But most umbrella policies require that your underlying coverage meets a certain minimum before the umbrella even activates. So if your landlord policy has a $100,000 liability limit and your umbrella requires $300,000 before it kicks in, you have a $200,000 gap coming straight out of your own pocket before any umbrella protection touches the claim. A $3 million umbrella sounds impressive, but if the foundation underneath has cracks in it, that umbrella may not perform the way you think it will. So the first conversation we have with any client about asset protection always starts here. Review your underlying policy. Make sure the limits reflect your wealth today, not what your wealth looked like 10 years ago. Once the foundation is solid, the next question is whether your legal structure is protecting you. And for rental property owners specifically, LLCs are one of the most powerful tools available. Here's the simplest way to think about it. When you own a rental property in your personal name, a tenant lawsuit comes straight at you personally. Your savings, your retirement accounts, your home, all of it is potentially in play. When an LLC owns the property, you've put a legal wall between the property and your personal wealth. A tenant sues the LLC, not you. And done correctly, getting from that lawsuit to your personal assets becomes much harder for a plaintiff's attorney to accomplish. If you own rental properties in multiple states, the structure gets more layered. The general approach is a separate LLC in each state where you own property, since each state has its own landlord-tenant laws and liability rules. And if you own multiple properties in one state, some states allow what's called a serious LLC. It works like a filing cabinet with separate drawers, one for each property. The liability from one drawer cannot reach the others. It's more efficient than running multiple standalone LLCs. But not every state allows this structure, so ask your attorney whether it's available where your property is allocated. Now, I want to be honest about something. LLCs are genuinely powerful, but they are not the right move for everyone. Our clients heard all of this and decided not to go that route. Not because it wasn't a good idea on paper, but they are approaching retirement, and their number one goal right now is simplifying their lives, not adding administrative complexity. Multiple LLCs across 3 states means separate bank accounts, separate bookkeeping, annual filings in each state, and ongoing overhead every year. And that's an important principle. Asset protection strategies should always align with your lifestyle and priorities, not just theoretical best practices. The best strategy is the one that you will actually maintain. Umbrella insurance is the strategy most people have heard of, but almost nobody has sized it correctly. Here's a good rule of thumb. Your umbrella coverage should be roughly equal to your net worth. If you have $5 million in assets, you want at least $5 million in umbrella coverage. Think of it like a security deposit on your wealth. You wouldn't put down $1 million to protect a $5 million asset. The same idea applies here. Most people are significantly under on this. A $1 million umbrella sounds like a lot until you realize that a serious personal injury lawsuit, a bad car accident, a tenant who gets badly hurt on your property can easily result in a $2 or $3 million judgment. At that point, your umbrella is exhausted, and the rest comes directly from your assets. The good news is that umbrella insurance is one of the best deals in personal finance, dollar for dollar. Going from a $1 million umbrella to a $3 million umbrella might cost you an extra $500 to $600 per year. Going from $3 million to $5 million, maybe another $300 to $500. For less than the cost of a nice dinner out each month, you are adding millions in protection. 2 things to verify with your insurance advisor. First, make sure your umbrella explicitly covers your rental properties and any LLCs that hold those properties. A lot of standard personal umbrella policies do not automatically extend to rental properties or entities you own. You may need a commercial umbrella or a specifically endorsed policy. Get that confirmed in writing. Second, if you own rentals in multiple states, confirm your coverage applies in all of them. Some policies have geographic limitations buried in the fine print that most people never read until they actually need to make a claim. Now, insurance is an important layer of protection, but it isn't the only one. There is another strategy we discussed with this client that most people have never heard of. It costs nothing to implement, and it can protect millions of dollars that are currently sitting exposed. Your 401k has unlimited federal creditor protection under a law called ERISA, the Employee Retirement Income Security Act. In other words, creditors generally cannot reach assets inside a workplace retirement plan like a 401k, no matter how large the balance is. A 401k with a $500,000 gets the same protection as the one with $5 million. It's completely off the table in a lawsuit. Your IRA, completely different story. IRAs do receive federal bankruptcy protection, but only up to about $1.7 million per person under current law. And outside of bankruptcy, IRA protection depends on your state law. Some states fully protect IRAs. Others offer limited or inconsistent protection. California, for example, provides some protection, but it's not unlimited, and courts have significant discretion in determining how much of the account is actually protected. So here's what that means practically. If you and your spouse have $3 million sitting in IRAs and you own rental properties in a state with limited IRA protection, a meaningful portion of that retirement savings is potentially reachable in a serious lawsuit. Think of it this way. Your 401k is a vault with a federal lock. Your IRA is protected too, but the strength of that lock depends entirely on the state you live in. When we reviewed this client's situation, they had several $1 million sitting in IRAs, and their workplace 401k plan allows outside retirement assets to be rolled in. So one of the ideas we discussed was straightforward. Move the IRA balances into the 401k. That shifts the assets from state-dependent protection into a federally protected account. And this works in reverse too. If you're approaching retirement and thinking about rolling your 401k into an IRA, it's worth pausing on that decision if asset protection is a concern. Once the money leaves the 401k, that federal ERISA protection no longer applies. Your IRA will be subject to state law instead, and that protection varies significantly depending on where you live. The best part is that this change can often be implemented without any additional cost. No new insurance to buy, no legal structures to set up or maintain. It's simply a direct trustee to trustee rollover. The money stays invested, and there is no tax consequences when the transfer is done correctly. One important thing to confirm before doing this: not every 401k plan accepts incoming rollovers. Some plans only take contributions through payroll. Call your plan administrator and ask whether the plan allows incoming IRA rollovers. But if the plan allows it, this is often the highest impact, zero-cost move in the entire asset protection conversation. Now, let's pull this all together, because the real power isn't in any single strategy, it's in how the layers work together. When these pieces are coordinated properly, a lawsuit against one of your properties has a very difficult time reaching your personal wealth. The claim hits the landlord policy first. If that's exhausted, the umbrella steps in. If an LLC is in place and properly maintained, your personal accounts become much harder to reach, and your retirement savings remain protected under federal law regardless of what happens outside. Each layer makes the next one harder to get through. That's the entire idea. And keep in mind, this isn't only about rental properties, car accidents, guests injured at your home, even liability from a social gathering at your house. Any of these can result in a judgment that exceeds your underlying coverage. The layers matter regardless of how the lawsuit originates. Here's where to start if you are thinking about your own situation. First, pull out every insurance policy you own, your home, your cars, your rental properties, and look specifically at liability limits. Not the property value coverage, the liability limits. If any of them haven't been reviewed in the past 2 or 3 years, they are probably too low for where your wealth is today. Second, check whether your umbrella policy is sized appropriately relative to your net worth, and confirm it explicitly covers your rental properties and any entities that hold them. If you own rentals, also ask your attorney and financial advisor whether an LLC structure makes sense for your situation and your state. And third, find out how your retirement assets are split between IRAs and 401k plans, and ask your plan administrator whether outside rollovers are accepted. If they are, that conversation with your advisor is worth having sooner rather than later. Every household is different, but these 3 steps will tell you quickly whether you have gaps worth addressing. If you've spent years building meaningful wealth, protecting it deserves the same attention you gave to growing it. Most of the families we work with have already done many of the right things. They have insurance, retirement accounts, and sometimes LLCs. The challenge is that these pieces often get set up at different times and never fully coordinated with each other. If you want a second set of eyes on how your protection layers are actually working together, there is a link in the description to schedule a conversation. Sometimes a single conversation is all it takes to get clarity. One strategy we didn't cover today is a specific type of trust designed to protect assets from creditors in ways that insurance and LLC structures can't. It's called a domestic asset protection trust. In that video, I walk through a case where that structure helped protect $14 million in assets. Make sure to check it out too. Thanks for watching.